Abhay Agarwal, Managing Director of Piper Serica Advisors, get about his investing decisions in a scenario like this. Let's get him on the show to talk about that. Abhay, great having you. Thanks so much for taking the time out and being with us. Just off the bat, Abhay, before we talk about the specifics, are you completely deployed in terms of capital because of the number of emerging opportunities both in private and public markets, or are you conservative and sitting on a bit of cash because there are some uncertainties out there in terms of interest rate trajectories, trade tensions, and more?
Yes, good morning, Neeraj. Always a pleasure to be on the show with you. We are largely deployed. I think we see enough opportunities in the market, though because of the valuations being where they are, even good opportunities are at times overpriced. So one needs to look harder, look longer. But I think opportunities are there. That's what we believe. So we are largely deployed. I think there is room in our model portfolio for some churn that we will do post the earnings season. But other than that, we are not sitting on any cash expecting a market correction or trying to time the market right now.
Okay. Abhay, if the earnings season lives up to the expectations or maybe beats it marginally, and I think banks will have to do the heavy lifting here in all probability, does that give the market the much needed ammo for maintaining the levels or maybe staging a rally?
I think, Neeraj, the problem with the market has been the constant selling by FPIs. So I think the pressure on the market has largely been technical in nature over the last quarter. I think fundamentals have been improving. There has been a lot of support from the government and government agencies to get consumption going, get production going. There have been interest rate cuts, there have been GST cuts, there have been other ways of making it easy for people to do business. So I think there is that positive support. Companies that we engage with are optimistic. The festive season is better than expected. Largely, banks' collection ratios that we are seeing are improving. So I think a lot of things have fallen into place fundamentally. The technical pressure of when do FPIs start believing that India is a market they want to come back to or deploy again, I think that rests largely on this tariff issue, because I think that worries the foreign investors more than the local investors. So more than the results, I would say, Neeraj, that any resolution or even a quasi resolution to the constant threat of incremental tariffs is what will bring the foreign investors back. And I think that will set us up for new highs.
Abhay, hi, morning, Tamanna here, and always great to speak with you. Now, clearly FPIs are on their own journey. Domestic investors are doing their own thing. The big trigger for us right now is what's going to happen in the second quarter. Business updates already coming in. Our financials front and center, yes, that's the data we have, so we're starting with that conversation. But a bit of a mixed view when you look at what analysts are saying on how this quarter is going to pan out for financials. How are you seeing it?
Good morning, Tamanna. We are very optimistic and almost bullish on the banking and financial services space. I think over the last 4 quarters, or probably 6 quarters, 4 to 6 quarters, we saw a cyclical downturn which happened because of overlending, lack of credit offtake, low collection ratios, RBI tougher mandates to do provisioning, which had impact again on the balance sheets. But what we are seeing now, Tamanna, is that there is a lot of positive support from the RBI. Even if you look at the recent credit committee meeting announcements, it's not limited just to rate cuts. I think more importantly, RBI is using other tools to get credit offtake going, to get make it easier for banks and NBFCs to lend, especially to the lower strata that depends on credit for their livelihood. So as per the recent MFIN data, there are 6 crore potential borrowers bottom of the pyramid who are not getting loans since last 1 year when banks stopped lending to NBFCs and NBFCs stopped lending to microfinance institutions. So I'm very positive that all of this will come together, play out positively over the next 3 months. In terms of the results per se, I think we will see largely inline results, but I expect the commentary to be more positive. And I think that's what the investors are going to focus on. But looking at the data that we are seeing, I think a cyclical bottom for the entire banking and financial services industry has been formed. And as consumption picks up, I think this is a sector that will gain a lot from the uptick.
No, so within this space and within this one bucket, Abhay, are you looking at that positive commentary incrementally coming in from your top private banks, or do you think that that alpha will be from your NBFCs or your MFIs, which were seeing a lot of heat last quarter, and that is now dissipating?
Yeah. I think the alpha definitely will be from the smaller banks, especially some SFBs like Ujjivan, Jana that are expecting a universal banking license soon. Purely for the fact that their valuations haven't recovered, even as the earnings are in sight of being recovery. If you look at the book value multiples, they are about 1 to 1.5 times. So as the earnings improve, I think that there will be both a multiple pickup driven by higher earnings and higher valuation multiple. So that is why I think the smaller banks and some NBFCs, especially the MFIs, which are trading at anywhere from 0.6 to 1 time book value, will also re-rate as their collection efficiency improves. And we are seeing that in the data. So, but at the same time, when things haven't gone well for last 4 quarters, it is difficult for investors to start looking for a turnaround. But whatever we are seeing, I think clearly the alpha will be with the smaller banks and NBFCs, especially those who have still unsecured lending portfolio.
Got it. Abhay, yeah, so you clearly bending towards the ones which were out of favor for the last 4 or 5 quarters to play a catch-up trade. Would that be the best way to put your current thesis on financials?
Yes, that would be a good summary. And catch up, I would just say catch up not to the multiples of the large private vector banks, because they have large or higher multiples for the right reasons, but catch up to the mean valuations that these banks and NBFC used to trade at earlier. So that's a catch up we are looking at. So I think that itself is like a one-time recovery in price, and then further on the basis of earnings growth.
Now, Abhay, the second question that I have is, now, if we move our financials, a lot of the new age sectors are available in the private markets in a big way. Yeah. Where is it that in the public markets do you find opportunities for the themes of the future available at reasonable valuations? Does such a combination exist?
I think it exists, Neeraj, but it's getting harder because the valuations are not stopping at high. Now they are, especially in the consumer internet space, we are seeing the valuations at a level where it could just happen that these stocks go sideways because they are already borrowing returns from the future. And we have seen that happen in multiple sectors. They overheat. And then they go sideways. So I think these are great companies that we are talking about in the consumer internet space. They are market leaders. They have gone through the valley of death, survived, thrived. So they will grow. But are they trading at a valuation that investors can say that they will definitely make money? Probably not. Though there are some opportunities that exist. I think more than consumer internet, if we say that where is growth going to come from, our bet has been in our model portfolio on the entire EMS space that Neeraj, you and I have talked about earlier also. So I think the electronic manufacturing, outsourced manufacturing plus ODM, I think these are the companies that still have very high growth left in front of them. And some of them are still available at a reasonable valuation when you build in the growth in there. So by themselves, they may not look attractive. But if you start building in the growth, I think these are the companies that are still available at a price that investors can look at multi-bagger returns.
What about on the retail side, Abhay? I mean, Trent getting punished for business updates that were below par or at least below expectations of the street. Their peers who also reported business updates at the same time, received much better. What would you do with that space, and where do you see that consumption boom going forward now that the first burst of lower GST rates, etc., is behind us?
No, I think the brick and mortar retailers, the large ones, classic example of some of them getting the market fancy and trading at levels where the valuations were just unsustainable for brick and mortar retailers. I think India is a market where we have the highest multiple, highest valuation for brick and mortar retailers. So not surprised at all that these companies are going through a bit of cyclical or business driven degrowth. The smaller ones that are more nimble and focus more on the tier 2, tier 3, and some even starting to look at below that. I think they will continue to see faster growth because of the format. But the larger ones, like the one you mentioned, and which I can see on the screen, these are the ones I think will struggle for growth because they also are in metros. They are competing head on with quick commerce, e-commerce players. So I will not be surprised to see them go sideways or go through this correction phase for a bit longer.
What would be the alternative then to brick and mortar play if you still wanted to write that consumption story?
So I think some of the smaller players, which are not metro focused but looking at beyond metros, I think their commentary is better and they are still seeing growth. So I think the story then moves to tier 2, tier 3 cities, names like Vishal, Megamart, and others which will still see growth. But I think more importantly, it is the whole pattern is changing towards digital consumption. You have very strong players led by large industrial groups that have built very strong e-commerce presence. And I think most of the consumption is higher there. The growth is higher than the brick and mortar. So I think that's the way it has played out around the world. And I think India is not going to be an exception to that.
India is not going to be exception to that. It's the Bharat story when it comes to retail. I think that's very interesting. Thank you so much, Abhay Agarwal, for speaking with us. Always a pleasure to have you.